0.5% to all-time highs, though we start the day down 30 minutes ago until the start of cash equity trading. I'm Dani Burger.
And I'm Bonnie Quinn. Bloomberg Open Interest starts right now.
Coming up on the show, TSMC's bullish outlook fails to reignite the tech rally as traders question the AI trade.
Stocks extending losses after modest retail sales, but Bank of America's CEO tells Bloomberg the consumer remains resilient.
And in other deal news, Uber scoops up Delivery Hero while Lilly acquires a psychedelic drug maker.
Let's get into some details then. Stocks to watch. TSMC raising its sales outlook, another sign of confidence in AI demand through the year. And yet shares of big tech stocks are down as investors look for justification for sky-high valuations. As you can see, the big AI players, memory chips, but really also the Mag 7. It's just basically all of tech today, Dani.
We also have some big health news coming out. So to start with, we had earnings. UnitedHealth, they topped second quarter expectations. They raised its full year profit forecast, signaling easing medical costs and early progress in its turnaround efforts. We heard from some other medical companies that had poor earnings to start the week, so surprise to the upside for them, up 7 1/3% in the pre-market.
Well, that data we just got, retail sales climbing modestly in June, dragged down by gas station receipts. Let's get a read on the data with Bloomberg International Economics and Policy correspondent Michael McKee. So was this just a function of gas prices? In effect, Michael, they're back below $2 a gallon now, so perhaps things will improve.
Well, it's probably not going to happen, Bonnie, because gas prices are heading back up again on the wake of the resumption of the war. But it was gasoline prices that dragged us down, and not just gasoline prices, but other categories, probably because people were still paying more for gas. Headline comes in up 0.2%, significantly down from May's 1%, and that was basically all cars, takeaway cars, and you're down 0.2%. Retail control, though, which is what goes into GDP, was up a relatively strong 0.5%, 0.5% after 0.8 the month before. So Americans still spending money, and what you'd say maybe is this is just good enough. But as you say, it's gasoline prices. You look at what's happened with gasoline prices over the last 3-4 months as we've gotten into and out of this war. They've been way up, they've been down, and that's there to the end of June. And now we're going back up in July. So we'll see what happens when we get the July numbers and how that influences people's spending. A couple of other numbers that were out today were pretty good. The Philadelphia Fed really rocketing up, 41.4 for July. That's one of the early reads on manufacturing for July, a big change from 10.3. New orders were up. Prices paid did not drop. Did not drop. They went up just a touch, but not a lot. And employment went up a little bit. And today we also saw jobless claims come in at 208,000, another drop. And it just continues to show the labor market hanging in there, which is what we heard from Kevin Warsh this week, and American consumers hanging in there. So it's really inflation that remains everybody's concern, going down in the month of June with gas prices, going up again now.
And only a 12% odds of a rate hike this month. Mike, thank you so much. Bloomberg's Michael McKee with the latest economic data. Elsewhere in tech, TSMC raised its sales outlook amid a mega trend of demand. Not enough, though, to lift the broader AI trade. Let's bring in Bloomberg Tech's Ed Ludlow. Ed, it seems like good numbers be damned. This is a nervy market.
Yeah, there's a lot of focus on beat across the board, raising the revenue outlook, but I think the market is interpreting the raised capital expenditure expectations in a really specific way. So TSMC said it will spend even more in 2026, a boost of $8 billion, so the range is now $60 billion to $64 billion US dollars. But what TSMC's CFO warned is that over the next 3 years, that those numbers get even bigger. So if the leading third-party chip manufacturers of the world is saying their capital expenditures is higher, you look at how we're trading in US equity markets in the pre-market, the types of names that are down, logic, memory, other capital expenditure deployers, it's a recalculation. It's not that there's evidence that the payoff's here, it's that we need to recalculate even higher capital expenditure environment going forward, which is like a really interesting overnight change of psychology.
Yeah, we're seeing it across the board. And also, you know, we only have 1 day trading left this week, and Korea's closed. A lot of other factors going on as well. Ed, I also want to ask you about the Uber deal. It seems pretty complicated. It's a bunch of Delivery Hero markets going to Uber and a bunch more going to private equity. Explain it to us.
Yeah, I mean, in this case, very simply, Uber has agreed officially confirmation to buy Delivery Hero, 41 euros and 50 cents a share, and it's a big premium to their attempt earlier in the summer or in the spring in May. Why would Uber do this? The same reason that all of Uber and its smaller peers have looked at M&A. It puts you into markets that you're not already in. So in Delivery Hero's case, 50 markets that they have operations in, and it gives Uber something particularly outside of America, right? I think there's a lack of understanding really about how these companies operate ex-US. The complication on the funding side is that it's cash, debt. There's a $14 billion bridge loan, and separately, SSW Partners is going to acquire some of Delivery Hero's markets that Uber isn't going to take. Well, if it gets the deal done,
Exactly. You got to imagine there were a few lawyers on that one. Ed, thank you so much. Bloomberg Tech's Ed Ludlow. Regional banks continue to beat expectations, joining Wall Street's biggest lenders in posting solid results. Bank of America CEO Brian Moynihan spoke with Bloomberg Surveillance.
What we see in our data is a consumer spending. If the consumers spend in America, that means the economy is okay, and that probably means the rest of the markets and the construct and the final demand is there. Despite higher energy prices, despite inflation, despite the Fed having to keep rates higher, despite all that, the economy is growing through it.
Let's get more from Bloomberg Intelligence senior bank analyst Herman Chan. Herman, the macro trends that help the bigger banks and brokerages, is that what helped the regionals too?
Yes, so we're really seeing strong results from the regional banks as well. Some of it is due to the strong capital markets activity. Recall on Tuesday, the big banks really posted blowout quarters, particularly in equity trading. But for the regionals, some of that is in capital markets, but a lot of that is also in net interest income, where you're seeing a lot of growth opportunities, particularly in commercial lending and a resurgence in commercial real estate as well. So that's propping the top line for them.
Did any of them in particular, the regionals, stand out to you? Because I know we had U.S. Bancorp this morning, PNC yesterday, First Horizon. Right. Did any of them in particular stand out as winners to you?
Yeah, the winners are M&T probably looks like the biggest winner from the reporting so far. They posted really strong lending results, and they are a bit more heavier in commercial real estate historically, and they're seeing really strong results there that should lift top line revenues and interest income for the back half of the year.
So are all of these regionals happy as standalones, or might there be a little consolidation in the air?
Yeah, consolidation is something that we think is going to happen over the longer term. That being said, really slow activity in the first half of this year. I think a lot of it is just due to what we just talked about. There's really strong performance across the banking industry, where why would you really want to sell now if you're an executive leading this bank? Because you've got really stable credit quality, you've got loan growth opportunities, you're going to generate better revenues this year. So things are really, really positive. So maybe when there's a bit more uncertainty in the marketplace, you'll see more activity. But right now, banks are doing really well.
Yeah, I feel like you and the team wrote about this early in the year when banks weren't doing well. It was like, oh, it's prime for M&A. But
Right.
does that mean, for example, Santander coming and buying Webster, buying a regional bank?
Right.
What about that sort of like cross-border M&A, a big European bank wanting more U.S. exposure? Is that just less likely if the CEO of a regional is like, we're happy to stand alone?
Right. That one was interesting because the Webster executive team is going to lead the U.S. operations for Santander, at least for the regional banking operations. So a deal like that would make sense if the target executive team is in place. Usually that doesn't happen, which is why you're not seeing a lot of activity.
And then how are these regionals competing with the online banks, Herman? How is that going? I mean, there's so many online banks now, from SoFi, to,
Yeah.
I mean, I don't even know half of them. There's new ones popping up every day.
That is one of the questions going forward is deposits, and particularly the cost of deposits. We're expecting a potential rate hike in the back half of the year, and you're seeing a lot of loan growth opportunities that I mentioned earlier. That could squeeze some of the funding costs that historically the banks, particularly the regional banks, have had in terms of low-cost funding. Going forward, you could see margins get squeezed a little bit, and that's probably the biggest risk going forward in the back half of this year.
Herman, thank you so much for joining us basically every day this week I think every day this week for bank earnings. We'll give you a break. Herman Chan of Bloomberg Intelligence, probably the busiest man in New York this week. A check on your equity markets this morning, and we decline after 2 consecutive days of gains that got us to within 0.5% of all-time highs. The Nasdaq, though, leads the declines. It's a weird, nervy market. It seems to be being led by yields moving to the upside, some 4 basis points. We're nearing 4.6%, even though the trend has been lower rates, which has allowed us to basically price out a rate hike for this month. Brent crude, that's up 1%, trading at just under $86 a barrel, Vani.
Yeah, I mean, there's definitely a lot going on in the Middle East, and obviously that speech tonight, we'll see what President Trump says. Let's get a look at some individual movers. Eli Lilly buying Peter Thiel-backed psychedelic drug maker Beckley for just under $4 billion. That's good for both stocks, it seems. Netflix reporting after the bell amid concerns around audience engagement. Netflix shares down nearly 45% in the past year.
We're also awaiting a launch from SpaceX. It's going to launch Starlink satellites on its Starship rocket for the first time since its IPO. Just want to point out we're still trading below its IPO price. That happened for the first time yesterday. Its IPO price was $135. Its debt also trading below par. Will this rocket launch help it at all?
Coming up, a pair of aviation companies lift outlooks as the industry holds strong. We take a look at United and also GE Aerospace next. This is Bloomberg Open Interest. Now to high interest, a look at what's making headlines around the world. The US expanded strikes on Iran, hitting an oil tanker near Iran's main export terminal as Tehran fires missiles towards US bases in Kuwait and Jordan. Shipping through the Strait of Hormuz is slowing sharply, raising fresh concerns over global oil supplies, while both sides threaten further escalation. South Korea cracking down on risky leveraged ETFs tied to single stocks such as Samsung and SK Hynix. Regulators will temporarily halt new listings, triple the minimum cash requirements to trade these products, and tighten investor education after a retail trading boom caused huge swings in the country's stock market. And United Airlines raised its full-year profit outlook, citing resilient travel demand, but higher fuel costs are weighing on the current quarter, with the airline expecting about $6 billion in added fuel expense this year. CEO Scott Kirby told Bloomberg TV airfares are also set to rise.
The airfares are down 13% in real terms from pre-COVID. So a short answer is yes. And in fact, there's been another fare increase this week. There were 5 or 6 when oil prices first spiked, and then when oil came down, they sort of paused. But there was another one this week, and so demand is strong. The consumer is strong.
For more, we are joined by Sid Phillip, Bloomberg Global Aviation Chief Correspondent. Sid, it was United that upgraded their outlook, saying that travel demand is still high. There seems to be some disappointment. What was the fly in the ointment for United?
So the disappointment for United was the fact that the current quarter, the third quarter, is looking a bit weaker than the analysts expected, and that's largely down to fuel prices going up and also demand sort of ticket prices being where they are at and not being able to sort of recover as much of the sort of fuel increase as the airline expected to. And so United saying the demand's still strong, they're still sort of cashing in on premium outlook and premium sort of travel, international travel. And those have sort of been the main sort of drivers for both United and Delta. And that sort of helped them stand out even as fuel prices sort of batter airline earnings.
But we're also potentially staring down way higher fuel prices once again. It could be much worse this time depending what happens. So how are the airlines preparing?
So the airlines in the US do not hedge fuel, and so they're sort of much more exposed to what fuel prices are at the time of flight. And so for the airline industry, fuel is a major expense, and that's why there's sort of uncertainty about how airlines will actually meet this. I mean, there's speculation as to what fuel prices might be and how airlines will be able to recover it. I mean, so far, premium demand is held up, and so airlines have been raising fares as much as they can to try and recoup some of those higher costs. But depending on how those fuel costs go up and how the airline customer demand plays out, we'll have to wait and watch.
They're also all tinkering around so much with their offerings. Delta, like the other airlines, coming out with this basic business, which I could go on an hour-long rant about how I hate that idea. But then United also earlier this week saying that for our Economy Plus on some of our planes, they're basically going to put a table in between, so it's shared between the two people. What sort of, I'm guessing this strategy must work because they keep doing these types of things. What exactly does the consumer want? What are they trying to meet? What sort of demands are they trying to meet?
So they're trying to sort of create that segmentation of customer demand where everyone's a premium customer, everyone's willing to pay a little more to try and get more comfort, more sort of creature comforts. And so you may not be quite willing to pay for first class, where you have the lie flat seats, but you will be willing to pay for something that has a little more space and a little more sort of comfort. And that's what the airlines are sort of counting on, that people will keep upgrading. And so they're having like little steps in between economy and first class where you have
It's like they're just trying to squeeze every penny out of us.
I mean, that's exactly it. I mean, you're trying to sort of get as much premium revenue as you can. And
diluting the luxury, though, in the process. Listen, it's also trickling down to other companies. So this better news for airlines also helping GE Aerospace, which anticipates selling a lot more engines.
Yeah, so GE Aerospace has raised its outlook again, and that's sort of the 7th time since January 2024. And that's basically because there's a huge demand for engine spare parts, engines, and sort of aircraft spare parts. And GE sort of focused mainly on aircraft engines. So they look at overhauling those engines. They look at actually building new engines and supplying them to Airbus and Boeing. And so for GE, this is a massive business opportunity because airlines are continuing to fly their aircraft. You continue to see airlines sort of sending planes for overhaul, and that's sort of continuing to drive demand. And they've also been able to sort of cash in on the higher sort of prices because there's been such a backlog of service demand and such a backlog at service centers that airlines have been forced to pay much more to get those engines out of the shop quicker and actually get them back on the plane.
I said literally only 30 seconds here, but earlier Scott Kirby on Bloomberg TV basically said that there might be more fare increases. Do you expect that these airlines, when they increase fares, that they're keeping them there?
So the airlines have talked about how they will increase fares and keep them there because they will need to be repaying those higher fuel costs that they encountered at the start of the year. And it's an opportunity for the airlines to sort of keep being able to raise prices. But at the same time, you've got competition. And so how much more will customers be willing to pay? And also everyone's trying to get customers to buy their premium offering. So let's see how that plays out.
Sid, very much so looking to your coverage of Farnborough next week. You'll be at the air show. I hope you have some good sunglasses and some good linens. It's going to be hot, exactly. I assume. Sid, thank you so much for joining. That's Bloomberg's Sid Phillip. Coming up, Man Group's Kristina Hooper says you should be selective with the tech trade, but sees a bright spot with cybersecurity. She's going to join us next. You're watching Bloomberg Open Interest.
The only time that you ever see earnings growth this big is when you are coming out of recession and you're comparing yourself to numbers that were incredibly depressed because you're in a recession. This just never happens. I don't know, is this a forced standard deviation event? This is kind of like once in a lifetime stuff. And it's not, we talk about the AI trade, but if you're looking at the numbers that are being put up by the financials, and we're not, we're talking about asset managers, we're talking about banks, we're talking about trading, this is extraordinary.
Seaport's John Golub on recent earnings growth of expectations. Let's bring in Man Group Chief Market Strategist Kristina Hooper. Kristina, great to see you this morning. Thanks for stopping by. And look, expectations are really high. Some of the figures that we've seen, something like an expected 20% increase from the year prior. Do you think that this bar is too high for corporate America to meet and beat?
I absolutely think it is. It may be the case that it meets it this quarter, but I do believe that we're setting ourselves up for unrealistic expectations by the end of this year. There's a lot happening, a lot of change going on, and I think companies are going to find it increasingly difficult, especially in certain industries, to get to the expected level of profits.
Kristina, how did we end up here? How are we doing so well? I mean, there were so many concerns for a long time, and it feels like it doesn't matter. It doesn't matter what concerns turn up on our plates. The market just powers ahead.
Well, I think
companies, not just the market, but corporate America.
Absolutely. Well, I think there is a lot of excitement about the AI Capex build out, and that has driven a lot of the earnings growth that we've seen. So there is a foundation for it. The problem is that I don't think risks have been properly calculated. And so, for example, you have surprises like the ceasefire actually being over and war escalating. That really hasn't been factored in, I think. There's just been this expectation that we're going to get through this, we're not going to have any more issues, we're going to do a look through. Now, some of that comes from the perspective of last year, in that we had these tariff announcements, everyone panicked, huge sell-off, and then we sailed right through it. But that was a unilateral situation where the president could turn them on and turn them off when he wanted to. This involves other parties, and so it's not as simple. And so I believe there's this view that there's a POTUS put. But we can't really have a POTUS put when we have a war going on and other parties involved.
So you have this one big existential risk there of what's happening in the Middle East. And AI is the other one. I wonder if you think that's properly priced in, because when you think about what terminal value is going to be for some of these companies, year 6 and beyond, we hardly know how the technology is going to advance in 2 years' time. And I wonder if that accounts for some of the volatility as we try to find what is actually fair value for these companies in the AI ecosystem, or are potentially disrupted by the AI ecosystem?
Yeah, I think that's a great question, because we are at the start and the early innings of what is a transformational technology that has the potential to make so many changes to our economy, make so many changes to companies' profit margins, a number of employees, all kinds of things. But we just don't know how this is going to evolve. So this is no different than any other enormous transformational technology, in that there are many surprises, many twists and turns. And I do believe we've gotten very, very accustomed to an increase in spend, always exceeding expectations every year. I think that's coming to an end. I think what we're likely to see is actually a pretty significant slowdown, because it's going to be difficult getting financing. Investors, shareholders are not going to be as positive on companies spending almost all their free cash flow on this build out. I think this is going to slow down. And of course, there are external forces like public sentiment, like New York's decision to stop data center building. So,
Christine, we have to pay our bills and go to a commercial break, but I want to talk more about this. This is so interesting. Kristina Hooper sticking around with us. Just 4 minutes to go until your opening bell as stocks move lower this morning. Just moments away from the start of your cash equity trade. You're watching Bloomberg Open Interest. I'm Dani Burger. 2 days of gains turns into a loss today. We're down 0.25%. It's this back and forth with tech, some volatility in this market, no clear catalyst. Even though we did have TSMC earnings, they looked pretty strong. We're down 0.7%. The Dow, though, still able to put in gains this morning. Down at the New York Stock Exchange, we have an IPO ringing the bell, C Squared. You wouldn't know from the name, but you could probably guess what the company does, considering what everyone does now, and that's AI data centers. So that's why they're ringing the bell. Down at the NASDAQ, we have an already listed company. I believe they're celebrating one of their anniversaries, Amplitech. They have more than doubled their share price in the past year. They do 5G and make a lot of the technology that goes behind things like microwaves and other complicated technology that helps cell towers. Here's the tech trade this morning, again under pressure. The chip stocks are selling off and selling off hard. SanDisk down nearly 5%. TSMC down 3%, even though it raised its sales outlook, showing another sign in the confidence of AI demand this year. But they were spending more than expected. And again, there does seem to be this nervousness creeping into markets about just how much Capex is being committed by these companies.
Yeah, so much churn, Dani. It's unbelievable. Well, UnitedHealth topped second quarter expectations and raised its full year profit forecast, signaling easing medical costs and early progress in its turnaround efforts. Let's bring back Man Group Chief Market Strategist Kristina Hooper. So there are other sectors out there, it seems, Kristina. We don't have to just concentrate on tech, the Mag 7, the Lag 7, and the AI trade. But they're risky, right? Would you want to be going into something like healthcare now when it's all up in the air as to what the insurers are going to be doing in 6 months to 12 months' time?
Well, I certainly think there's some significant change that is likely in the industry, but I do believe there are some opportunities, pharmas, biotech. The pharmaceutical companies are cash cows. There are some pretty significant dividend yields there. And so if you think about having a diversified portfolio, having some parts of your portfolio that are low valuation, higher yield, you want to go to areas like healthcare. Of course, you want to be selective, though. This is not a time to index.
If we can go back to this idea that there's this risk in this market that the hyperscalers pull back in their capital expenditures, because we've heard from the Satya Nadellas of the world who've said and seem to be sticking by this idea, the risk is underspending, not overspending. What do you think changes that causes them to not grow their Capex at the rate they currently are?
Well, it could be a variety of things. I mean, you have these not in my backyard movements that are they're gaining speed. I mean, it's amazing how much sentiment has flipped so quickly on AI. If you're a commencement speaker this season and mentioned AI, forget it.
Tough
You get
crowd.
booed for 5-10 minutes. And I think there are many communities that would rather have a maximum security prison in them than have an AI data center at this point. And so I think that certainly could slow the build out down because it's going to take years for the vision of having data centers floating out in space, right? You also have the potential for components to get a lot more expensive. We saw that semiconductor prices have gone up. Chips are far more expensive. That's why Apple raised prices on its laptops. And so it could be that the spend has to slow just because these components cost so much. And then, of course, financing. You have shareholders. You have just an abundance of debt out there, perhaps not as many buyers. We saw the 30-year Treasury auction wasn't great. There's a lot of debt competing for some owners. And there is also, of course, shareholders. And shareholders thus far have been fairly positive, but you can see that changing when it comes to the hyperscalers. And also rare earth elements. I mean, there could be a time when the U.S. develops a frostier relationship with China and it's harder to source rare earth elements, or at least the processing of them.
No, that's never going to happen, Kristina. Kidding. So when you say slow the build out, who does that affect? Because all these orders are already in. So would it affect the memory chip makers? Would it affect the steel makers that supply the steel for the data centers? Who does it affect?
Well, it really depends on how much of a slowdown it is, right? So it could very well be that it's still enough to keep going, but it does affect all the components, unless, of course, you have something that could be a game changer. So the big issue with the data center build out is largely about electricity usage and driving up costs. So for those firms that can come up with more efficient sources of energy, sources that hyperscalers can utilize in the build out of data centers so they're not plugging into the power grid. That kind of thing, I think, has long legs, even if CapEx spending slows. But then there are other areas where they could take a hit because the build out slows. Keep in mind that a lot of the surveys, a lot of the anecdotal information we're hearing thus far is that AI is really working for coding. That is just an incredible technology in terms of advancing coding and not needing coders. But when you extend out beyond that, we're not hearing as many good things. So it could take longer to see an adoption. And then I think that just slows the whole food chain.
I have vibe coded an app. It doesn't work well. But I did vibe code something, which is ridiculous
What
that
was
I
the app
myself.
for?
It basically emails me who's ringing the opening bell every day.
Oh,
yeah.
brilliant.
I
thought it was going to be where the open tennis courts.
No, that's also a really good app, and I should build that. I wonder though, okay, if the payoff is less than expected, that seems to be a bigger problem just because the money that's sloshing around this ecosystem is just the capex. It's not the return on investment yet. Considering this is a market that's being held up by the pillar of these tech companies and its economy that's really been leaning into the spending and the industrial revolution that's coming alongside this, a slower spend and a slower payoff, is that not something that wouldn't just take the index down with it, but maybe the American economy?
Well, I think there's certainly that potential. And then, of course, if you see the index go down, then that has ramifications for high-income consumers. Because if we think about kind of the two legs that have been driving the U.S. economy in 2025 and thus far in 26, it's been the AI capex build-out, and it has been consumer spending, but only high-income consumers who are very, very sensitive to the stock market. And so if we were to see some kind of stock market sell-off, that could really slow consumer spending. So yes, this is all very interconnected and could be problematic for both the stock market and the overall U.S. economy.
Kristina, can I just ask you a brief question about Korea and the dynamics there? We finally got some movement from the regulators on these leveraged ETFs. you know, they make up a lot more of the trading environment in Korea than they do here, but there are very many of them here as well, and proliferating all the time. A, does it fix the Korea stability problem? And B, could we see something like that here?
Well, I think there are question marks. Certainly it has the potential to, and hopefully it will. But you know, keep in mind, there's a lot going on in Korea, and a lot is riding on, actually, the AI trade. So you know, it certainly could go some ways to fixing the stability problem, but I can't say that with such a narrow market, we're out of the woods.
So these are some really big risks you're talking about right now. How are you adjusting your portfolio and where you're thinking about where's safe in this market to maybe ride out or protect yourself from some of this if we do see some of those concerns manifest themselves?
Well, we have a wide variety of portfolios at Man, and I think that really, to me, is so important right now, having that ability to be well diversified, having exposure to portfolios that enable you to hedge risks. And you can do that in so many different ways. So I certainly think it's important to still have exposure to this AI theme. This is long lasting. It's likely to evolve a lot, just as we saw with the internet, with the tech boom of the late 1990s. So many of those companies have survived and thrived. It's all about being actively managed and evolving with the evolution of the technology. I think beyond that, though, is being well diversified, having hedges, and recognizing all the risks that are out there. We haven't even talked about the Fed and the potential for tightening.
We only got a minute left. Do you want to do that real quick?
Sure, you bet, absolutely. So I think the bigger risk right now is not the Fed funds rate. Right. It is the potential for a shrinking of the balance sheet. Yeah. Which I think has the very real ability to drive up yields on the long end. And of course, we have other forces at work that are also likely to drive up yields on the long end. That could exert downward pressure on equities.
How much do we shrink? He did say we're not going back to 2006 levels. That ship has sailed.
Yes, but this has been an environment in which the balance sheet is still very large. So any kind of material shrinkage could have an impact. You know, it's really interesting. As soon as the announcement came out about Kevin Warsh as the nominee for Fed chair back in late January, what we saw was the San Francisco proxy Fed funds rate started to diverge from the Fed funds rate. It started to tighten, and it has continued to tighten since then. And of course, that's factoring in all those other monetary policy tools that if you were to actually have them as part of the Fed funds rate, shows a tightening environment. And I think that's what we're going to get, and I think we have to factor that in.
Kristina, this has been an absolute masterclass. I hope you'll come back again soon. This was so excellent. That's Man Group's Kristina Hooper. And let's get a quick check on your equity market this morning, about 10 minutes into your trading day. Again, we declined down 0.4%. On the upside, we had some good health earnings. UnitedHealth Group, they're on the upside, and we did have some poor health earnings to start the week. So you're seeing a rebound there. Names like United, Johnson & Johnson. The consumer names are doing really well. Walmart, Coca-Cola. So it's the physical things that are doing well. What are not doing well are the tech things. Again, kind of maybe getting into some of the risks that Kristina was talking about. This spending and the concerns around it, especially since we heard that amplified by TSMC. So NVIDIA, Broadcom, Micron, a lot of the chip makers are down. And tech, so is one of the worst performing sectors this morning. If we flip it up and look at your group rank returns so far this morning, tech is doing poorly. Healthcare, actually unchanged, even though you had some of those big names doing well. Utilities, that's the worst performer, though. And the top performer, communication services and consumer discretionary. I actually, just looking at this, I think this is all wrong. If Val in the production room, if we can just hit the refresh, I actually don't think that this is today's session because we were down. There we go. There's your session today. Here's what it actually looks like. Infotech is down 1.6%. Healthcare up 2%. That makes a lot more sense. Vani.
Yes, it does indeed. Dani, well spotted. Coming up, Eli Lilly buys a psychedelic drug maker backed by billionaire Peter Thiel. We discuss the emerging medicine next. This is Bloomberg Open Interest. Time now for our top calls. Some of the analyst action in focus this morning. And first up, JP Morgan upgrading BlackRock, saying the company is set for stronger growth thanks to solid money coming in, rising revenue and improving profitability. The firm adds that investor worries about private markets and private credit are not having a meaningful impact on BlackRock's business. Next up, Lululemon getting cut to a sell at Truist. The firm says the brand is losing buzz online, sees growing consumer concerns and warns the leadership transition could slow any turnaround. Stock higher nevertheless. And finally, UnitedHealth's second quarter clears a high bar. Evercore ISI says the results show the business is getting back on track, while Mizuho says the quarter came in even better than bullish investors expected, thanks to lower medical costs and strong performance at Optum Health. Dani.
Elsewhere in the world of pharma, Eli Lilly is buying a Peter Thiel-backed drug maker, Atai Beckley, for up to $3.8 billion, underscoring the firm's growing interest in psychedelics. Bloomberg's Madison Muller covers the space and joins us now. What exactly is Lilly buying with this thing, Madison?
Yeah, so Lilly is buying into this fast-growing psychedelic space, which was once really on the fringes of drug development, but has gotten a lot more interesting and a lot more interest from drug makers over the last year or so. There are now a couple of companies that are nearing potentially FDA approval. They're in late stages of testing. Atai Beckley is moving into late stages of testing. They have their lead drug is called BPL-003. It's actually a derivative or closely related to DMT, and it's an intranasal spray that is supposed to help with treatment-resistant depression. So it's similar to J&J's Spravato, which is a drug that's already approved for treatment-resistant depression. It's a nasal spray, and that drug has really created the infrastructure to allow things like this to have success in the market.
Yeah, what is the uptake on that drug, Maddie? And then, will the FDA just approve all of the rest of them because this is all accepted now and promoted?
Yeah, so J&J's Spravato, which is technically not a psychedelic, but kind of similar, has really opened the door to acceptance to these kinds of therapies. It's taken a few years. It was approved, I think, over 5 years ago at this point, and it was sort of slow to take off, but now it is a blockbuster drug for J&J, and a lot of clinics around the country have gotten more comfortable with prescribing something like this that requires patients to actually be in the clinic and be monitored for a couple of hours after getting a drug, just to make sure it's safe for them to drive home and things like that. And so it's, the expectation is that obviously the FDA will still look at all of these studies and drugs closely, but they're a lot more accepting of these kinds of medications than they once were. And the Trump administration is also quite supportive of these efforts, and they're taking some steps to loosen restrictions around the studying of psychedelic drugs.
I don't mean to belittle the power of psychedelic drugs, especially in treating things like depression, but it feels somehow connected that on one hand, psychedelics are being used for medical purposes, and on the other hand, medical companies are a casino now that you can bet on Kalshi based on their drug outcomes. You wrote this story. What exactly is Kalshi offering?
Yeah, so Kalshi is deepening its offerings in biotech, essentially, offering more contracts related to clinical trials and FDA decisions. So exactly what we were just talking about, the FDA deciding whether or not to approve a drug. Now it's going to offer contracts explicitly tied to that. Both Kalshi and Polymarket have offered some healthcare related contracts, but this is sort of its biggest push yet into this world. And they're working with an AI powered platform called Applied XL that will sort of do the resolution behind the scenes and work on some of these contracts.
Is there nothing that can't be turned into a product? Nothing about our, wants and desires and need for dopamine?
Yeah, it seems like it.
Incredible, Maddie. Great story. That is Bloomberg's Madison Muller. And coming up, Bank of America CEO Brian Moynihan says the consumer remains resilient. More on that interview next. This is Bloomberg Open Interest.
Bank earnings continue to beat expectations as consumers spend, borrow, and invest. Bank of America CEO Brian Moynihan spoke on Bloomberg Surveillance.
You just saw two statistics that I've watched carefully, which is what the activity of the consumer is, and then ultimately what the unemployment new claims are. That's people argue it's leading or trailing, but it's actually an indicator of the health of the employment market, and a 4.2% unemployment rate with new claims at 1.8 on long-term claims and 208,000. Everybody looks at it and says, well, that's in line with 19. Remember that the workforce has actually grown a lot since 19 in terms of size, and so you argue about 7,000 on 160 million workers or something like that. So it's a pretty small number. And so nominally it's a low number, and percentage-wise it's a low number, and that's good news because that means the consumer spend. And what we see in our data is the consumer spending. The consumer spend in America, that means the economy is okay, and that probably means the rest of the markets and the construct and the final demand is there.
The weather for the banking industry has been shining brightly. The sun is out, the backdrop's great, the environment has been good. I want to draw a distinction between the environment and execution, because fees were up everywhere. What are you proud of after that quarter? On execution, where are you gaining market share?
Every single business grew the revenue, grew operating leverage, which is critical because that means your revenue is growing faster than expenses, and increased their returns. Every single business. It grew the customer bases and all those things. So what you're seeing us is the power that the engine of Bank of America is across all the businesses. So our consumer business made $3 billion after tax this quarter, plus. You know, that's half as much as Wells Fargo made, and you know, it's a big number. That's one of our 4 businesses that we disclose, in the smallest of which made $1.5 billion this quarter. So these are big businesses, they're scaled, they're accumulating new clients, they're accumulating new activity. The markets business had a great quarter, and the investment banking had a great year-over-year comparison. But at $2.1 billion for the quarter, we were $2 billion last quarter, 2.1. It looks like a huge increase because last year's second quarter, we all thought the world was coming in, and with Liberation Day, this year it's different. But what's really important is the pipeline they have is strong. The deals in discussion are strong, and you're seeing deals announced every day across all the spectrums, M&A, strategy, financing, all of which is important.
How concerned are you, and how much oxygen has been sucked out of the room from Mythos and some of the cybersecurity concerns from earlier this year? We heard some of your peers talking about that, and anecdotally, we hear a lot of fundamental concern about the risks to the financial system.
I think the administration looked at it quickly. The Secretary of Treasury and others said, wait a second. And so we all got started on this, and we've all been working a long time. And yet it just speeds up the pace of the work you have to do to patch the systems and do the things. So it's a serious concern. I think the so-called AI industry and industry writ large have worked together. But you can't think that we're ever going to be able to control this because there's foreign models that people use. And not everybody's going to have the same thought process that our country has, but our country's tried to handle it and tried to be pretty systematic about it. But it's a big change in the amount of work that will have to go on and the pace at which these tools will affect your vulnerabilities in your system and how fast you have to take care of that.
Bank of America CEO Brian Moynihan speaking on Bloomberg Surveillance, maybe echoing some of the concerns we heard from Jamie Dimon yesterday on the threat of widespread Mythos access and those advanced AI systems. We are about 20 minutes just over that into your trading day. Here's where we stand on these markets. It's another day where tech is selling off. These AI stocks have been extremely overowned. So even if you get good earnings like from TSMC, this risk exists that you get a sell-off. The NASDAQ falling 1.25%. Kristina Hooper of Man Group was talking about this, the fact that the cost of financing is getting more expensive, that you have political pushback on building data centers, and you still don't have that robust return on capital. Small caps in the Dow, though, those are still in the green, just showing you a sign of the times. As yields yields push higher, we're up by about 3 basis points. They're trading alongside oil this morning, and even though we had some of those kind of weaker retail reports, it was the lowest figure we had since January. Brent crude, that's up just 0.5%. We're trading at $85 a barrel. We still are pricing in about 12% odds that we get a hike this month, rather. Nvidia and SanDisk, again, look at SanDisk getting crushed in today's trade, down 9.2%. Everything is, all the tech players, again, very overowned, and a lot of these leverage ETFs that are now starting to get banned, at least a pause on new ones in South Korea because of the impact of what it does to this market when you have these ETF dealers that need to go and buy more exposure, and it can snowball into these markets. Some really good earnings when it came to the healthcare providers. UnitedHealth and Abbott both reporting really strong figures this morning. UnitedHealth up 8%, Abbott Laboratories up 13.4%. United Airlines, they upgraded their outlook. However, the current quarter seemed to have disappointed, and that's a problem considering we had those really strong numbers from Delta. So those shares down 3.6%. And again, Bank of America, we're just hearing from Brian Moynihan there. Those shares are down 0.7% in what has been a blockbuster quarter for the Wall Street banks. Coming up in the next hour, we're going to hear from Kathy Bostjancic on the inflation trends of this week, plus Carlyle's Pooja Goyal on their data center push, and the global president of TGI Fridays joins us to discuss the chain's expansion plans abroad. All of that in hour 2 of Bloomberg Open Interest. We are 30 minutes into your trading day. Welcome to Bloomberg Open Interest. I'm Dani Burger alongside Vonnie Quinn, clocking in losses in the early hours of the trade after 2 straight days of gains. Coming up on today's show, TSMC's bullish outlook fails to reignite the tech rally as traders question the AI trade.
The U.S. completes its latest airstrikes on Iran with tensions showing no sign of easing.
And on the eco front, retail sales rising modestly in June as consumers spend less money at the pump. Joining us now is Kathy Bostjancic, Nationwide Mutual Insurance Chief Economist. Kathy, great to see you this morning. And look, this is the lowest retail sales since January. It comes off the back of cooler CPI and PPI. Just taken as a whole, what is your view of this American economy after the data of this week?
Yeah, good morning, Dani. So I would say that the retail sales report overall was quite solid, particularly when you look beyond the headline. If you look at the core readings, which take out gasoline prices, and the reason gasoline sales, the reason to do that is because gasoline prices fell almost 10% on the month, so that depresses the headline reading. But the core readings were pretty solid. I would say that consumer spending for the quarter, for Q2, looks to be about 2%, which is very, very good. And the momentum going into Q3 also looks quite strong. And I'd say it's good, 2%. Usually that's kind of a moderate reading, but it's good given the upward rise that we saw in gasoline prices in the previous month. So consumers have been really resilient here and willing to spend.
Where is it coming from, Kathy? Because I wouldn't have said it was coming from wage growth. And while we did see inflation stall out a little bit and come down even, I mean, we're still experiencing plenty of inflation.
Yeah, no, it's a great point. And what we saw, Vonnie, is that consumers pull back on their savings rate. So the savings rate has fallen to about 3%. That it is quite low historically. And they've been willing to do that, ride out the higher energy prices, probably with the hope that that would dissipate. We did get a little reprieve in June. That did help the retail sales number, like outside of gasoline sales. But of course, the issue now and the headwind is that we have energy prices going back up, gasoline prices rising because of the renewed hostilities in the Middle East. That could be a bit more of a headwind for the consumer and the economy overall.
And this is a Fed Chair, Kevin Warsh, who has spent lengthy time, speaking with Congress about the unevenness of this American economy. And in the housing market in particular is something that he's honed in on. Kathy, we see it in long-term yields. They've been climbing higher, 30-year yield that's well above 5%, a 30-year real yield that's at its peak of 19 years. Is this a Fed that we need and we will continue to hear language from Waller, maybe even Fed Chair himself, that sounds more hawkish in order to try to push this market to bring long-term yields down?
It's a great point because we really have a divided Federal Open Market Committee right now. We tend to side more with the dovish view that the Fed does not need to raise interest rates, and nor will raising interest rates solve the energy price issue, right, or inflation from that, because that's supply driven. I guess if you really wanted to ramp up interest rates sharply, and that would drive demand down to be equal with supply, but that's not what you'd really want to slow the economy that much. And then with AI spending, that's also a source of inflation. But we would say that AI spending is really quite inelastic to interest rates, meaning it doesn't matter what the level of interest rates are unless they're sharply higher. These hyperscalers are going to keep spending. So, and even the tariffs are immune from interest rates. So I think that the Federal Reserve would be better suited to kind of ride this out, see how things play out. And if we get, some relief in the core CPI and core inflation, that's kind of the best they can hope for. But you're right, Waller and Fed Governor Cook have kind of given us the view that they're kind of intolerant right now. They've lost patience on the inflation front and willing to try raising interest rates to see if it'll rein things in.
Kathy, can I pull out one point you made in there? You said AI spending is inflationary. Fed Chair Warsh would not go there in his testimony. He would not say that it was an inflationary force. He talked about the productivity. I wonder what you make of that.
Yeah, so I think there's some truth to that. I think in the near term, it's inflationary, but I would agree that maybe inflationary is not the right term, it increases the price level, but not necessarily something you would say is inflationary several years out. Eventually, yeah, we're going to get really big productivity gains, and that tends to be disinflationary. So I agree with Fed Chair Warsh, and also New York Fed President Williams said the same thing as well yesterday.
But is it going to be a question of geography and timing, Kathy? So, you know, one area of the country might experience a lot of inflation and no productivity thanks to AI. Another, you know, area of the country might experience the opposite.
Yeah, I mean, there are unequal impacts here, both in timing and certainly can be as well in geography. You know, this AI build out is so enormous and really rather quick in a sense that it's overtaking the resources, right, that we have, whether it's electricity or even just the materials and chips. So there is some unevenness, some pain, but I think eventually if we get this economy-wide boost to productivity and across businesses, it turns out to be very positive for the U.S. economy.
Kathy, let's just wrap this up. What are you expecting in terms of the path of policy for this Federal Reserve?
So our base case has been that the Fed could remain on hold this year and should, but we do have to recognize the committee is turned more hawkish overall, and certainly the hawks are squawking louder. And it could be that we get, you know, one rate hike by the end of the year. But I think that we'll have to see how things play out. Maybe we'll have to see what the task force tell us, right? And it may be that Chair Warsh and Williams can kind of persuade the others to delay any rate increase.
All right, Kathy, thank you so much. Always a pleasure chatting with you. Kathy Bostjancic, Chief Economist at Nationwide Mutual Insurance. Brent is moving above $85 a barrel as the U.S. carries out another round of strikes against Iran. President Trump vows the military campaign will continue until Iran stops attacking ships in the Strait of Hormuz. The president spoke yesterday at the U.S. Army War College.
They want to settle so badly. They don't like what we're doing. And they do want to settle. We'll find out whether or not we settle with them or we just finish it off. A lot of people thought oil would go up to $350 a barrel, and today it's at $79. A couple of days ago, it was at $68. It went up a little bit because I had to take tough action because they did not obey.
For the latest, Bloomberg Washington correspondent Tyler Kendall joins us now. So one side escalates, then the other side escalates. Tyler, where does this stop? We have Iran now attacking Kuwait, Jordan, American bases there, and even potentially asking the Houthis to get back involved.
Right, and Vani, that would be a major escalation that would threaten shipping in another critical route that we know global energy flows go through. But perhaps the largest development that we got overnight is that the U.S. military confirmed that it hit a super tanker near Karg Island that was set to transit towards an Iranian port, marking the first such attack since the U.S. reimposed that naval blockade earlier this week. Now, the U.S. military says that it is actively working to secure the Strait of Hormuz. CENTCOM said that it helped assist at least 10 vessels overnight to make the journey through. But we have still, of course, seen those crossings drop very sharply. The latest data shows that the 7-day average for oil flows in the Strait has dropped from 4.6 million to 3.9 million barrels, according to RBC Capital Markets. And it is numbers like these that the Trump administration is watching, of course, very closely, as we have new reporting that the White House is considering extending that critical Jones Waiver Shipping Act in a bid to make sure that oil can still flow freely, at least in this country. So it's going to be something to watch really closely here because escalation is very much on the table as you're outlining. We're seeing both sides trade attacks. But Vani and Dani, I'm sure you saw this reporting from the Wall Street Journal that President Trump may be leaning towards a military operation expansion that could include ground troops, though the reporting indicates he hasn't made a decision just yet. And we did hear from the Vice President, J.D. Vance, yesterday in a podcast interview say that the U.S. isn't looking to put boots on the ground, at least right now.
We've gone back to what we experienced earlier this year, Tyler. So on one hand, we have escalation of the war in the Middle East. On the other hand, we learned late yesterday that the president was slapping a 25% tariff on Brazilian imports, of course, excluding beef and some other meats because voters care about those. I wonder if this is kind of the playbook. We are setting up to see an expiration in Section 122 of the Trade Act, those tariffs, which I believe expire later this month. What happens when that happens. This is kind of the playbook to reigniting and reimposing tariffs, Tyler.
Yeah, it feels like that, Dani, right? Because we know that the Trump administration has been trying to build back up that tariff wall after the Supreme Court blocked those broad-based levies under IEEPA, the International Emergency Economic Powers Act. What the administration has really been looking for is a more durable legal basis to ensure that tariffs can stay in place and for longer. A lot of that has been done through Section 301 investigations over alleged trade practices, and I think we're going to start to see a lot more of those come up instead of this 122 authority, which has a little bit more of a limited time frame around it. So it's definitely something to watch here. But it's interesting that it is coming at this point in time as we head closer to the midterm elections, and the economy, of course, remains top of mind for American voters, considering that we did see some of that voter pushback when it came to President Trump's tariff policies before, how the administration messages around this, how it could be good for perhaps national security interests, which is something that we see often in these investigations, protecting and bolstering domestic manufacturing. I think we're going to start to hear a lot more messaging around that as we get closer to November.
Tyler, thank you so much for your reporting this morning. Bloomberg's Tyler Kendall in Washington. Let's get a check on your equity markets about 40 minutes into your trading day. And we are seeing another day where momentum is unwinding. You're seeing it in the big tech stocks, both AI names with the check writers and takers, both the chip stocks and the hyperscalers are selling off today, down 0.7% for your NASDAQ 100, 0.1 for the S&P. As yields climb higher, Brent crude, that is still trading above $85 a barrel.
And a look at a few single stocks moving at this hour, Dani. TSMC raising its spending and revenue outlook for the year. The results seem to be renewing concerns around AI and the capital spending behind it, with those ADRs down nearly 2%, though it did rise in Taiwan trading.
We're waiting for SpaceX to launch a test flight of its massive Starship rocket later today for the first time since the company's IPO. A reminder, this thing IPO'd at $135, currently trading at just $1 above it.
UnitedHealth raising its outlook for the year and posting better than expected quarterly profit, helping to solidify the company's earnings recovery.
Coming up on the show, Carlyle's Chief Investment Officer of Global Infrastructure is going to join us next as her firm agrees to sell a data center power platform to EQT. That's coming up on the other side of this break.
Now to high interest to look at what's making headlines around the world. Extreme weather is hitting the U.S. from coast to coast. Wildfire smoke pushed New York City's air quality into the unhealthy range as dangerous heat strains power grids across the Midwest and East. Meanwhile, California is cutting power to reduce wildfire risk, and Texas is facing flash flooding after days of heavy rain. SpaceX is set to launch its 13th Starship test flight today from Texas. It's the first launch since its $86 billion IPO. The rocket will deploy 20 test Starlink satellites and then attempt engine relight and splashdowns. Success would move SpaceX closer to its first orbital Starship mission. And Apple is giving the iPad lineup a refresh. The iPad mini will get a higher quality display for the first time, with a launch expected by October, while updated entry-level iPads and iPad Air models are planned for next year. The move comes as Apple looks to keep iPad sales momentum going. Dani.
Let's turn now to private markets, and the Financial Times reporting that Carlyle is set to make a more than five-fold return on the sale of a $2.6 billion data center power platform to EQT. Joining us now is Pooja Goyal, Chief Investment Officer of the Global Infrastructure at Carlyle, the woman behind this deal. Pooja, thank you so much for joining. And look, the reporting suggesting a more than five-fold return on this investment. I mean, that's huge. I feel like 2 times is even really widely celebrated in the world of infrastructure, let alone 5. So you started building this thing in 2021 when AI was barely like a glimmer in our eye. Did you have any idea that this thing would grow to the behemoth and the attractiveness that it eventually did?
Well, first of all, Dani, thank you for having me here. You know, we have a very thesis-driven approach to investing in infrastructure at Carlyle. And back in 2020, we had a thesis that there was going to be significant demand for power generation capacity in the United States. And so instead of investing in an existing platform at a bloated valuation, we decided to build our own platform from scratch. We started with 4 employees, a year one budget of $3.5 million. Obviously, you mentioned the purchase price right now, $2.6 billion. And we decided to launch Copia Power to develop, build, own, and operate power generation capacity in the United States at scale, but yet do it in a profitable and commercial manner.
By the way, 3.5 million, that feels like a grain of sand on the beach compared to like the numbers that companies are now spending building up massive power platforms. I wonder if that made sense at the time to kind of slowly walk this thing up and not throw a bunch of money behind it. And now you have to be investing lots of money. Or can you repeat this feat? Can you build something from the ground up yet again?
So you're spot on. Infrastructure is a very capital intensive asset class. When we started developing the power generation assets for Copia Power, we decided to be very strategic. And we decided to build what we call our energy campuses. So we said, let's retain the optionality to co-locate projects that could one day use the power that Copia would generate. Now, 5 years back, we thought that those projects would probably be manufacturing plants or industrial processes that need electricity. It obviously turned out to be data centers and the demand for compute on the back of all of this growth in AI.
What about the rate environment? Because in 2021, we were hiking rates too, which makes infrastructure more complicated. And maybe we're kind of in a similar environment. We're not necessarily going to get hikes, but there is a concern that we will from this Federal Reserve. How are you thinking about building these platforms in that type of environment?
So that is spot on. And that is exactly what we were very focused on when scaling up Copia. Like I said, we were focused on building a commercial and profitable platform. Not all growth is accretive when your risk-free rate is going up by 400 basis points. And a lot of the existing platforms at that point in time were doing what I call everything everywhere all at once. And we said, let's pick the locations where we can drive scale, but make sure that that scale is accretive given the interest rate environment.
So you were early on this and early building out power capacity, but it feels like a trade that everybody is getting into. I mean, you hear of like ex-politicians getting in, leasing land from somewhere, trying to build things up. I wonder what you make of it, because clearly the demand for energy around AI is very real and very necessary. But on the other hand, is there a real risk that we might see some stranded assets?
Yeah, so look, when you are building infrastructure assets, especially those kind of data center assets that require tens of billions of dollars of capital, you have to be very thoughtful about your capital allocation decisions. We like front-of-the-meter grid-connected projects. You do not want to build islands or assets that could be stranded on a long-term basis. So investors, both on the credit as well as equity side of the equation, need to be extremely deliberate when it comes to making these capital allocation decisions.
So you've done the deal. What do you do with the proceeds now?
Well, so the deal is still subject to regulatory approval because these are energy assets. So, you know, the deal has been signed and we expect to apply for those regulatory approvals. But we believe that investing in AI-related infrastructure continues to be a very compelling investment opportunity. So we continue to see very attractive ways to deploy capital. The one thing to note is what we do at Carlyle is mid-cap infrastructure that enables us to actually innovate, get creative, build platforms from scratch, or partner up with founders relatively early on in their company's investment life cycle. So we are able to originate deal flow that is differentiated from the kind of deals you might typically read about.
How much of that is also just an acknowledgement that what exists out there now, maybe large cap, maybe some of the mid cap now, when it's not early, that valuations are maybe too frothy to be attractive?
I do think that there is a fair amount of exuberance that's out there. So again, people need to be very discerning when making these capital allocation decisions. I would say that exuberance is not just on the equity side of the capital stack, it is also potentially on the debt side of the capital stack. So when you're investing in assets, be deliberate about understanding stranded asset risk. When you're investing in companies, be mindful about how much growth you're underwriting, especially given the current macro environment.
Stranded asset risks, what are the other major risks that always go along with these kinds of investments? And when you're opening the books to somebody like EQT, what do they go and look at first? What is the main thing they want to know?
So with infrastructure assets, these are long duration assets. These are not assets that you value only over a 2 to 5 year time horizon. The ultimate value of your company or your platform is going to be primarily driven by the value of your assets. So in addition to making sure they're not going to be stranded assets, you do want to take into account the quality of your revenue contracts. So your customers, in the case of data centers, it would be the leases with your hyperscalers. In the case of power generation assets, it would be the credit quality of the utility or the end customer that you're selling power to. And also you want to make sure that those projects have been prudently financed as well as built. technology obsolescence can be a consideration. And you don't want to over-lever these assets as well because you want to get the cash coming off of these deals.
We were speaking, just quickly here, we were speaking with Kristina Hooper of Man Group, who said there is a real risk that some of the hyperscalers stop spending as much as they are. What happens to this whole ecosystem if you do see a hyperscaler pull back in less than a minute here, Pooja?
So this is a completely different business model for hyperscalers. They've gone from having companies that are fairly asset light to fairly asset intensive. And I do think that you might hit some roadblocks where projects might get delayed and move to the right. But not all projects are created equal, and I do continue to believe that the fundamental demand for compute is still very strong. So you will see growth in the long run.
Pooja, we're going to have to end it there. Thank you so much for joining us. Such an interesting deal and a platform that Carlyle has built. Pooja Goyal of Carlyle. Still ahead, TGI Fridays is looking to make a comeback with plans to open hundreds of new restaurants by the end of the decade. We're going to speak with the global president, Phil Broad. This is Bloomberg Open Interest. About an hour into your trading day, we are off the lows of this morning, but still moving lower. The Nasdaq leading those declines, down 0.9%. It's a real day of momentum selling off, and we've seen this in weeks past. Momentum leading the pack down, so that means big tech challenge. Russell 2000, that's doing okay, despite the fact the U.S. 10-year yield is up 3 basis points. Some individual companies, TSMC had good results, but again, we're jittery around tech. United Airlines, again, upgrade their outlook, but this quarter not as strong, so it sells off. GE also had earnings. Eli Lilly buying a psychedelics company, and UnitedHealth, good earnings. Coming up, we speak with the president of TGI Fridays, betting on a global comeback.
TGI Fridays looking to stage a comeback after filing for bankruptcy in 2024. The iconic casual dining chain is betting on international expansion and a brand overhaul as it targets more than 1,000 locations by 2030. The turnaround comes at a challenging time for the restaurant industry, with economic uncertainty weighing on consumers and food safety back in focus following a parasite outbreak linked to fresh produce. Joining us now is TGI Fridays Global President Phil Broad. Phil, welcome. It's been a minute since we've been into a TGI Fridays or thought of one, right? It's been a troublesome time for TGI Fridays. What is the plan to rescale this brand and find your sliver of the fast casual dining experience in America again?
Well, firstly, good morning, and thank you for having me on the call. Look, we're really excited about TGI Fridays in the US. We now operate over 80 restaurants across the country. We're seeing strong momentum. We're seeing a lot of interest in the brand in terms of more franchise wanting to come to us. But globally, we're seeing significant expansion. So, we still are the largest casual dining restaurant company by number of restaurants and number of countries we operate in. We're setting the target of 1,000 restaurants, and we're on the way to do that. We've already signed 150 restaurants into our pipeline over the past 12 months. And with many more to come. So, we're excited about what the opportunity is there for TGI Fridays.
To be clear, I have definitely thought of you all, especially if, I find myself walking through Times Square, which I try not to, and see your iconic locations there. Yeah. So you, post-bankruptcy, have shifted to something that looks more asset-light. Is that correct? You're more of a franchise model. With the parent company being owned by a private equity company, I wonder what you're thinking about long-term opportunities and the long-term strategy. Could you, for example, go public?
In the long term, we could do, but at the moment, we're really focused on just bringing the Fridays brand back. We already operate in 40 countries. We continue to grow that. We'll see another 3 or 4 countries sign over the next couple of weeks, which is exciting for us. And we believe that Fridays is an iconic brand. It's been around 60 years. I believe it will be around another 60 years. I worked for the brand 30 years ago. And still celebrate the fantastic brand it is. So we are very positive about the growth opportunity that exists for us.
So Phil, you're concentrating a lot on the international expansion, and I get that, and you have experience with Starbucks, for example, so you know that some of these franchises can have a difficult time of it in foreign countries. Sometimes they have to, change the menus, and sometimes that doesn't work, and then there's a lot of strategy shifts. What are you going to do to sort of square that circle?
First, I'd say we have some incredible partners already. I mean, we've got some that have been around with us for 30 years, real entrepreneurs who continue to build the brand from where they are today. But we do know that we have to flex the menu. So in certain countries, we'll flex 10 or 15% of the products on the menu to suit local taste. And that certainly seems to be working. But you look at the World Cup we've just been through, and we're still going through, we're seeing so many restaurants full to the gunnels, people celebrating, coming to join Fridays, drinking our cocktails, ribs, steaks, and flying out the door. So look, we're really seeing a momentum in the brand globally, and we think that will continue. And as I said, you're going to see signings of more countries coming up shortly. We have a really solid base of franchisees who are excited about the brand. Our franchisee in Greece, who's been with us now for over 30 years, has just signed another development agreement to open more restaurants. Peru continues to grow again. They've been with us for 30 years and they want to open more restaurants and take more territory. So that we generally are seeing big momentum. We believe there's a gap in the market for casual dining because a lot of people have left the market, but we're excited about having this white space that TGI Fridays can fill.
Phil, if I can just jump in, because I want to pick up on that point, because there's a reason that a lot of people have left this market, and it's some of the woes that TGI Fridays originally experienced when you went through bankruptcy. Some of them are still with us. Consumers feeling the cumulative weight of inflation, challenges from more of the fast casual type chains, and then competitors who have started to really cut costs, or cut prices rather, in order to draw in that challenged low income consumer. How do you bring people in, especially here in the US, without completely destroying your margins?
Look, I believe we're in the people business serving food, and we've always got to have everyday value on our menu. And we continue to strive to do that. But people will still eat across our menu. And guests want to come in and have a great experience. They want to celebrate, but they don't want to empty their pockets. And so, we're very closely monitoring that. We've seen some of our competitors, and we watch them very closely what they're doing to make sure we're competitive and make sure that we do protect our margins. I mean, we're in the business to make money, have fun, and look after the people that work for us. But I believe that, where we're sitting at the moment, we're in a very strong, positive position. And we're actually seeing our like-for-like sales come back pretty strongly, as well as on delivery, which we think is very exciting as well.
Phil, do your international units and franchisees source locally in their countries? And if not, is it from the States? And what are your US stores and franchises doing about this parasite that seems to be, invading fresh produce and maybe turning away customers?
Look, we have no reason to believe we have any of that in our business. I mean, yesterday I had every single franchisee on a call. I personally spoke to them to talk through the procedures we have in place. We've had all our suppliers. We've spoken to all of them. Number one priority for us is safety of our guests and safety of the team members that work for us. And so our procedures are very, very strong. We also liaise continually with the health authorities to make sure our procedures are very strong and some of the strongest in the world. And as I said, we've been in the industry a very long time, so our systems are very strong in our restaurants, and we'll do everything we can to protect our consumers. And that's all we can really do at the moment, but we're watching it every single day.
It has grabbed a lot of headlines, Phil, perhaps because of the truly horrifying ramifications of contracting this parasite.
Yes.
And I wonder, even if you're taking all the safety precautions in the world, if you have seen consumer behavior change, maybe less fresh vegetables, avoiding salads, anything like that?
We haven't seen that change, but what we are watching is where does the parasite potentially come from? There could be certain ingredients coming through the supply chain that could be more prone to it. And as we get more and more advice, if there are certain products that we think could have a more susceptible to cause this issue, we'll withdraw it from our supply chain to protect the team. But again, we have a really great supply chain team, very professional, been with us 15 years, who continually monitor this to make sure we do everything we can to secure the safety of our guests. So for us at the moment, it's really on the radar. We're laser focused on it, and our guests can be assured that we're doing everything we can to make sure they're safe.
So you're in Dubai at the moment, Phil, and obviously the Middle East is, a difficult market for many businesses now. Are you in the Middle East at all? And what, beyond the countries that you mentioned, what are you targeting in terms of United States re-expansion?
I currently live in the Middle East. I live in Dubai. We have an office in Dubai, an office in London, an office in Dallas. But we are targeting growth in the USA. I mean, we are laser focused on that. I'm there again in a couple of weeks' time. Ray Blanchett, our CEO, I've been with TGI Fridays for over 35 years. We know the franchisee base. And because we're seeing a lot of success in our current restaurants, and we're seeing like-for-like sales growth, our franchisees are feeling more confident about the brand. We've launched Fridays United for the World Cup. We've got kids, we've got celebration, we've got a real quality focus, delivery and good value. We've got 4 current franchisees talking to us who actually want to get back into TGI Fridays. They want to do a development agreement with us to grow the brand again. So look, there's a lot of momentum behind the brand. People love it. They love the food. It's wide variety. We've got some really classic dishes that people just crave for. You know, our whiskey glaze has been around a long time, but you can't get it anywhere else. So people crave it, want to come back. Our Cajun chicken shrimp pasta, #1 seller in every market in the world, and people just crave it again. So I think we've got some really good gangbuster products that are really going to help us drive momentum. But we certainly are seeing momentum of franchisees. We've got a brilliant COO in the market who's doing a great job of doing deals for us. So look, we see a very bright future for TGI Fridays.
Phil, when I think of TGI Fridays, I think of like one of my first jobs in a mall that had a TGI Fridays in it too. And when we would close, all of us would go together and go to TGI Fridays and like stuff our faces on these huge like pasta dishes and burgers and stuff. But that also has me thinking, it's these quite indulgent meals. How much has the rise of GLP-1s affected your business?
Look, people come to us for a celebration, but people also can have half portions. So people learn to eat through our menu. And if they want a lighter meal, they can have it. We're continually getting guest feedback saying, fantastic that we could split the salad, we could share the main course, we could halve the dessert. So that we're very aware of what's happening with consumer trends, and we're on top of it and make sure that what we can offer suits people with different dietary requirements. I mean, the industry's been at that forever, right? There's always something new we have to adapt to. And I think we've adapted very well to the latest. But, you know, we have a lot of employees who work for us on the same. We have a lot of people in the support center. So we're mindful that every guest who comes through the door has to have a tailored experience, and our people have to be trained to really well look after them. So I think, you know, every trend will continue, and we'll make sure we look after our guests in the right way. But, you know, you've got to come to Fridays and have fun. I mean, that's the brand is all about fun and celebration and lifting your spirits when you come through the door, but also eat carefully through our menu, and you can have a fantastic time and watch your calories.
Hey, Phil, so great to have you on. We're going to have to end the conversation there. Appreciate your time. That's TGI Fridays Global President Phil Broad. Let's get a check on your equity markets just over an hour into your trading day as we continue to face a market which is logging on declines, only 0.1% for the S&P, but it did see 2 consecutive days of gains. It seems to be unwound by an unwinding of momentum. How much longer does this have to go as both chips and hyperscalers sell off this morning, down 0.8%? Yields are creeping back higher, up 4 basis points after a heavy week of economic data. Today brought us retail sales. Brent crude also trending higher by 0.25%.
And let's take a look at some single stocks moving at this hour. United Airlines boosting its outlook, expecting resilient travel demand to drive up profit despite soaring fuel costs.
And then there's also a similar story for GE Aerospace. The company raised its full-year forecast, topped earning expectations, citing robust travel demand.
And Eli Lilly agreeing to buy Peter Thiel-backed drug maker Atai for up to $3.8 billion, underscoring the firm's growing interest in psychedelics.
Coming up on the show, hedge fund giants finding a new profit engine, snapping up ideas from their smaller rivals. We're going to discuss our latest big take next. You're watching Bloomberg Open Interest. The world's biggest hedge funds are zeroing in on a new way of making money, tapping portfolio managers at smaller firms for ideas and paying for buy-side alpha signals. Sources telling Bloomberg that Balyasny and Millennium are the latest big names to consider drawing on other hedge funds for trading signals. Joining us now is Bloomberg chief hedge fund correspondent Nishant Kumar, who co-wrote our big take this morning. Nishant, already a lot of these funds that are adopting this model have pod shops. Why go even a step further, if not just have their own individual traders trading among assets of pools, but also try to tap outside talent in their ideas?
You know, the answer is very simple, because hiring the best people has become extremely expensive. It's a very slow process, and it's a very competitive process. So, you know, why not rent some of it, actually? So that's the model developing. The biggest hedge funds already employ many of the world's best traders. They cannot hire like everyone, and not everyone wants to join them. And they're managing so much money, enormous amounts of money, that they constantly need to add to their talent pool. Alpha capture in some ways solves that problem, because all of a sudden you access this vast number of talent pool that you can rent it out, of course, try them out. If they're good enough, maybe give them an SMA. And if they do really well, you can hire them as well.
So what are the kinds of fees or sharing agreements involved here, Nishant? And are there really that many hedge funds that have fresh ideas for these big shops?
Even if not fresh ideas, this can help you figure out how the street is positioned, what are the consensus trades. So not only to what you want to buy, but also what you want to avoid. In terms of fees, there are two elements of fees in this. You get a fixed pay, which is not very high, and you get a cut from the performance. So in our report, we have said that a typical alpha capture contributor gets something like between $10,000, $20,000 a year to $750,000 a year. And of course, this is a moving target. It depends on who you are, how valuable your contribution is, actually.
Nishant, you get into this a bit in the story, but I wonder about some of the legal ramifications of this idea that you're relying on outside people for these ideas, and how do you know that they didn't come to those ideas via some nefarious or insider trading activity?
Well, you don't. So that's where some of the risks are, that compliance is a big problem. So you are kind of relied on a third person, that they will do the job right and they won't land you in trouble. So there is that element. But then there are other risks, like the crowding risk. If a lot of these hedge fund managers are chasing similar signals, because alpha capture is not exclusive. A hedge fund is able to share the same idea with as many hedge funds as he wants. So therefore, there is that crowding element as well. And the third biggest problem is, how do your investors feel about you sharing your best idea, your edge, that your investors are paying for, with someone else who is paying some incremental amounts of money? So alpha leakage is a real problem that these hedge funds need to solve and convince their investors.
Does it ever happen, and is it a problem at all, Nishant, if these funds decide to partner up for ideas, but then the bigger fund, the Millennium or whatever, bets against the idea that they just heard?
Well, they are free to do anything that they want. All these hedge funds are doing is, there is a web portal or a format in which they are inputting all their ideas, their price targets, their logic behind it. And then, the likes of Millennium, Citadel, Point72, they decide what to take, what not to take, how to size, how much to bet on that trade, whether for or against. It's totally in their control.
All right, Nishant, thank you so much. And an excellent read. I suggest everyone go read it. NI Big Take is where you can find that on your terminal. Bloomberg's Nishant Kumar. Coming up, Netflix faces a big earnings test after losing more than 40% from its peak. We're going to take a look at the streaming giant next ahead of their earnings. This is Bloomberg Open Interest.
Netflix reports its second quarter results after the close today, and investors are increasingly concerned about the streaming giant's growth prospects. Joining us now is Bloomberg Intelligence media analyst Geeta Ranganathan. Geeta, first let's talk to engagement, because if you can engage the customer, then you'll likely grow. Is the bottom in for engagement?
Yeah, this has been a real problem for Netflix, Vani. We've seen the latest Nielsen Gauge numbers, which reports one of the lowest levels for Netflix engagement at about 7.8% in April. And that's kind of pretty low over at least the last 10 to 12 months. So we're, when you compare it with December, Netflix was at 9%. And really, this kind of feeds into this overall growth narrative. And we've seen investor concerns pop up ever since Netflix made that big bid for Warner Brothers, willing to pay close to almost $70 to $80 billion. And then there were questions even at that time about engagement. And then now when we see these numbers, this really kind of spooks investors. So today when Netflix reports, they're going to have to come in and kind of soothe investor concerns and talk about their strategy and their strategic direction going forward.
There's some irony behind this of Netflix when they're originally going after Paramount, saying like, we don't need this, but it'd be good for us, and the shareholders being like, you really don't need this, don't go after it. And now there seems to be this chatter swirling around, okay, does Netflix need to go after another studio? I know there have been some talks around Lionsgate. Netflix's name hasn't exactly been thrown in the ring for those who are looking for it, but Geetha, do you think that Netflix needs to start pursuing another studio?
I think investors are really looking for something to kind of reinvigorate the narrative here, Dani. And yes, you absolutely point to the irony because, they did not want that kind of overhang from M&A. They did not want to make, what was a very clean story. We didn't want to kind of muddy the waters there. But looking at, just the streaming competition right now, and it's not just from the rest of the streamers, really, it's from all of social media. And that's where, so much of the fears lie. Will AI created content and short form video from the likes of a YouTube, a TikTok, will that really be the ultimate disruptor? And in order for Netflix to kind of defend their turf, yes, maybe they do need to get more studio content, more differentiated IP, especially when we see this kind of plateauing of engagement.
Yeah, I mean, to an extent, YouTube has become a massive competitor that nobody would have seen coming back a while, Geetha. Would Netflix and YouTube do some kind of partnership where Netflix would feature YouTube TV more?
Yeah, I mean, they are actually looking into that right now, Vani. So, starting in the first week of August, we're going to see Netflix actually debut, a lot more short form content. So yes, there potentially could be some partnership with YouTube or other social media platforms. And it's not just that. I mean, they're really kind of diversifying to different types of content to really, make sure that engagement kind of stays and grows. And we've seen them kind of go after a lot of different types of live events, a lot of sporting content, but ultimately they need to do something much, much more substantial to really make sure that they can maintain that engagement metric.
And the sports and the live content are just getting ever more expensive, Geetha. Is that a problem for the company, the spending that it needs to do in order to get this content?
I don't think it is, Dani, because if you look at their content budget today, yes, they are increasing their content budget by about 10% to $20 billion for 2026, but not a huge part of that is sports. So out of that $20 billion, you're looking at maybe about 600 to 700 million, which is sports. But ultimately, if they're looking at advertising to really drive their revenue, then they do need that captive audience. And in order for them to have that captive audience, live sports time and again proves that it really works. We're seeing some huge numbers just from the FIFA World Cup for Fox, for Telemundo. So, ultimately, I think even though sports rights are expensive, I think it will provide good bang for the buck.
All right, Geetha, thank you so much. That's Geetha Raghunathan of Bloomberg Intelligence as Netflix looks to recoup some of its losses over the past year heading into their earnings. A quick check on your equity markets. We are down about 0.1% for the S&P 500. The NASDAQ, having a rougher go of it, is now down more than 1%. Again, it's a big momentum sell-off, and you can see that's bringing some of the chip makers down with it, down 3.5%. It's remarkable just how volatile chip makers have been, along with the Mag 7. It's a rare day that both of them are trading off, but that is happening today, though Alphabet starting to climb back into the green, so it's not trading as even. And Brent crude now dropping into losses, now down 0.2%. It had been gaining earlier, but it is trading at just under $85 a barrel, Vani.
Yeah, it really is interesting to watch these memory chip makers sell off so hard. I mean, you have Seagate down 6%, and then the cloud, neo clouds as well, Nebius down 8-9%. Such a volatile market. All right, coming up tomorrow, Dani.
Sarah Hunt of Alpine Saxon Woods will be joining on markets. We'll have Jason Basnet of Citi to react to Netflix earnings, and Joanna Shu of University of Michigan following the UMich Consumer Reports.